This Chapter 2 discusses the principal accounting and regulatory capital issues relevant to conduits. These accounting and regulatory issues are, unfortunately, extremely complex, are subject to numerous differences across different jurisdictions, and are often undergoing significant changes, particularly in consequence of the recent financial meltdown, which therefore makes it almost impossible to review them in an exact manner. It will suffice if we can highlight the key issues and provide a broad overview of what they are and how they have been tackled in general. We begin with the accounting issues. The first accounting question is whether the seller can account for the transaction from the perspective of its balance sheet as a simple sale of assets, or rather as some sort of secured loan. The latter treatment, as we have discussed previously, would result in an increase in the seller's leverage ratio and deterioration in its debt service ratio. We now illustrate this with a specific example. The simplified balance sheet you see here shows a seller with $100 of receivables, $100 of other assets, $100 of debt, and $100 of equity. Prior to the transaction, the debt-equity ratio is therefore 1. Sale treatment, if it is granted, would simply require the seller to replace the receivables with the cash received from the SPV, leaving the debt-equity ratio unchanged. We have ignored the accounting treatment for the haircut, which complicates matters a little, but in a way that does not affect the teaching point of this illustration. If, however, the transaction is treated as a secured loan for accounting purposes, then under this treatment, the receivables would remain on the seller's balance sheet. The seller would add $100 of cash into its assets and would increase its debt to $200. Of course, this causes the debt-equity ratio to double, presumably a very undesirable outcome. Fortunately, sale treatment has generally been permitted, particularly where the haircut applied to the sale of the receivables is a small percentage of the total pool, generally referred to as limited recourse. In essence, this rule recognizes that there has been a real transfer of economic risk from the seller to the conduit and to its investors. It also acknowledges the reality that the debt issued by the SPV is really intended to be repaid from the receivables cash flow and the PWCE and liquidity lines exclusively. When these features prove insufficient in aggregate the seller does not stand behind the commercial paper nor guarantees it in any way. Thus, to reflect the SPV's debt on the balance sheet of the sellers would be inaccurate. A related accounting issue is whether the conduit, or SPV, is truly a standalone entity with its own independent financial statements, or needs to be consolidated into the financial statements of one of the key parties, such as the sellers, the sponsor, or perhaps the liquidity or PWCE provider. Unfortunately, the specific rules addressing this question have reached a state of mind-boggling complexity and are undergoing even further revisions as a direct consequence of the credit crisis. It is difficult to generalize for all structures and jurisdictions, but we can say with reasonable accuracy that consolidation, and normally by the sponsor, is increasingly likely under International Financial Reporting Standards, IFRS, and will also most probably become the norm in the United States as well once the promised new rules stemming from the credit crisis are finalized. Increasingly, the accounting profession looks not so much to who owns the conduit, but rather to who controls it, or sometimes to who derives the greatest economic benefits from the conduit. The view is that off-balance sheet treatment has effectively resulted in understated balance sheets for the large players in the conduit business. Note importantly that the sellers are unlikely to be the ones consolidating the conduit, except perhaps in those instances in which the conduit is proprietary to only one or perhaps two sellers, leaving the vehicle otherwise usually off balance sheet for the sellers, but not generally for the sponsor. With regard to the capital treatment of multi-seller vehicles under Basle, the issues arise principally in connection with how much capital must be allocated by the provider of the PWCE, the banks providing the liquidity support, the sponsor of the program, to the extent it may be required to consolidate the SPV under the accounting principles we have discussed above, and finally, the CP note holders. Of course, we are assuming in each case, for purposes of this discussion, that the party in question is a commercial bank and therefore subject to Basel capital regulation. Other regimes of regulation would apply to other entities, such as insurance companies and possibly others. To begin, the PWCE provider is viewed as providing a contingent credit guarantee that is triggered partly or wholly only when the write-offs on a given pool exceed the related haircut. Since the haircuts are set at pretty conservative levels that represent several multiples of historical loss rates, it is generally possible to demonstrate that the risk of a draw on the PWCE is modest, indeed modest enough to be able to achieve an investment grade credit rating. Therefore, the capital requirement is equivalent to that which would apply to any securitized investment rated investment grade under Basel II. Basel II generally applies risk weights ranging from as low as 7% to as high as 100% for investment grade securitized paper. The exact risk weight depends principally on credit rating, seniority, and the extent of pool diversification. Assuming the worst case scenario for the PWCE, then a 100% risk weight, as shown in this grid, would apply, which would therefore make the capital charge 8% of the size of the PWCE. In our earlier example, remember, the PWCE itself was 5% of the total program size. Multiplying the 8% by the 5%, the capital charge is therefore 0.4% of the program size. Assuming now that the bank charges its customers a sort of facility fee to access the program of 15 basis points, the return on capital for the bank before any expenses, taxes, and credit losses becomes 37.5%, as shown at the bottom of the slide. This would generally be more than acceptable given the limited risks that the bank is incurring under the PWCE. For the liquidity providers, the rules have changed significantly between Basel I and Basel II. Basel I allowed very generously a zero capital charge for the liquidity lines on the basis that those were typically 364-day committed facilities and could not be drawn upon to cover credit write-offs, but only to ensure liquidity. Basel II, unfortunately, has overturned this rule and has replaced it with one that differentiates among liquidity facilities based on a number of variables: the period of the bank's commitment, whether the facility is in some way used to provide credit enhancement rather than mere liquidity support, and whether the liquidity provider ranks pari passu, i.e. at the same level of seniority with other creditors once his facility is drawn, or would in fact be subordinated to them. In short, the end result of all this complexity is that most liquidity facilities today require some capital, as opposed to zero before, but in a few exceptional cases it is still possible to obtain a zero capital charge. For the program sponsor, the regulators generally continue to allow off-balance sheet treatment for capital purposes, and therefore no capital is required other than any that may apply by reason of the provision by the sponsor of liquidity or credit enhancement pursuant to one of the earlier discussed provisions. This is so even when the accounting guidelines do require consolidation by the sponsor. It is uncertain at the present date whether this may change in consequence of the credit crisis. For the commercial paper note holders, finally, the treatment under Basel II depends principally on the credit rating of the CP and a few other factors, but generally, since the CP is almost always in the highest eligible category of credit ratings, it achieves a risk weight between 7% and 20%.